this lesson, we're going to take a look at the first topic in grade 11 called adjustments in the final accounts. So in grade 10, we ended with final accounts where we looked at trade, profit and loss account, and also the balance sheet. So now here we're going to discuss adjustments to certain entries in those. So in this video we are going to discuss two types of expenditure, that is capital expenditure and revenue expenditure. So we discussed a bit about this when we're just starting accounts, but we're going to go just a bit detailed to understand the importance of differentiating capital expenditure and revenue expenditure. Then in the next lesson, we'll look at depreciation. We'll know what depreciation is. We'll look at different methods of calculating depreciation and also its importance. Then after that, in the next video, we'll look at disposal of fixed assets. You have a fixed asset, you want to dispose it of. How do you do the accounting? Then we are also going to discuss bad debts, okay? And we'll end with prepayments and accruals. So we'll start with a definition, okay, of expenditure. Definition of expenditure. So expenditure is just the disbursement of funds for acquiring assets or services for the business, okay? So any activity that involves paying out money in an effort to acquire assets or services for the business, it is called an expenditure, okay? So proper classification of expenditure is very important for accurate financial reporting. So here are more terms that we're going to discuss and their definitions. So expenditure, I've defined that. So now there's also a term which is a type of expenditure called capital expenditure, which simply is the spending that is done to acquire or improve fixed assets for long-term benefits. So I'll explain more on this. Then there's also revenue expenditure, which is the spending that is done on daily operations, including maintenance of assets. Okay. Then there are also two types of income. There's capital income, which are proceeds from the sale of fixed assets or long-term investments. Okay. So if you sell a fixed asset, what you get is called capital income. Then revenue income is the money you make from normal trading activities, such as when you sell your cakes, if you are in the business of selling cakes. Okay, so now let's go into details. Capital expenditure, as defined, is an expenditure that has the feature of long-term in nature, meaning that once you spend money on whatever that is, you are going to have what the asset for a long time. You're going to have what you are going to get in exchange of the money you are spending for a long time. Okay, so that is capital. That's one feature of capital expenditure. Also, it can be a spending that improves or acquires fixed assets. That is, if, for example, you have a vehicle, you buy an engine for that vehicle. The engine, of course, maybe improves the fixed asset. That is capital expenditure. Okay, or just buying a fixed asset. That is capital expenditure. The job is to be able to tell if an expense is capital expenditure or revenue expenditure. So we have to understand all the features of capital expenditure and also all the features of revenue expenditure. So here are some example scenarios. You purchase a machinery to use in your business. that is capital expenditure. Legal cost of buying a building. Okay, so you are buying a building. Okay, now when getting that building, there are legal costs, money that's going to to be spent to deal with legal issues. Okay, so that is capital expenditure. Okay, in short, when we are talking about capital expenditure, you are acquiring a fixed asset. So all the cost involved in acquiring that fixed asset is part of capital expenditure. Okay. Uh, uh, as another additional example from the point I'm from saying, carriage inwards on machinery. Okay, you buy a chigayo. For those who know what a chigayo is, so you bring that machinery into your premise, into your business premise, with maybe from South Africa. Okay, so you have these big vehicles that are carrying that machinery. So all the money involved is part of capital expenditure. Also, if you do some renovations to improve asset performance, okay, that is also capital expenditure. Okay, because this asset we're talking about is the fixed asset. So you do some renovation to improve the fixed asset performance. That is capital expenditure. So in other ways, we can say capital expenditure includes all the spending that is involved on acquiring fixed assets, bringing them into the business, legal cost of buying such fixed assets, carriage inwards on fixed assets that needs to be brought inside the premise, or that needs to be moved, and any other cost that is needed to get a fixed asset ready for use. Okay, so it is not just the cost of acquiring the fixed asset, but all the costs that are involved to make that fixed asset operational. Okay, those constitute or are part of capital expenditure. So the way we deal with capital expenditure, we debit the asset account. So if you buy a motor vehicle, we're going to debit the motor vehicle account. I think if you recall, in the previous lessons, we were debiting the machinery account. Okay, so fixed asset, we debit the asset account. Then we credit the bank, the cash, or the creditor. Okay, the manner in which we acquired that asset. Did we pay through a bank? Did we pay cash? Did we get it on credit? Okay, so if we got it on credit from maybe J Musa, then J Musa's account is going to be credited. If we bought using cash, then the cash account is going to be credited because cash was spent. And if we paid using the bank, then the bank account is going to be credited. So, of course, a fixed asset appears in balance sheet as an expenditure that is of type capital expenditure appears in balance sheet as a fixed asset. So this information, most of like 95% of it, since we were recording these transactions in balance sheets, in machinery accounts, in bank cash and creditors account, so you have an idea. So now let's look at the other type of expenditure, revenue expenditure. So this has the feature of it being recurring and short-term. Recurring means recurring means it happens frequently, like it keeps on happening. So like for example, electricity bills, every month you have to pay. So that's a revenue expenditure. Okay. So it's for daily operations and also maintenance. Examples include repairs to equipment, electricity bills, okay, petrol, diesel expenses, purchase of goods for resale. So when you spend money buying goods so that you can sell them, that is a revenue expenditure, okay, because it's not the acquiring of a fixed asset. Okay, you just buy something to resell. That's not a fixed asset. You're in the business of cars. You buy a car for resale. That is not capital expenditure. It's revenue expenditure because that car is meant to be sold. Okay. So the accounting treatment of revenue expenditure is you debit the expense account. Remember when we're starting accounts, when we're learning about double entry, we have always been doing the same thing. Expenditure, we debit. Okay. But now we are understanding that we just don't debit any expenditure. We debit revenue expenditure. Okay. Of course, we used to call them expenses by then. Okay, so we debit revenue expenditure. But if it's capital expenditure, you have to debit the asset account and credit the manner in which you acquired that asset. Okay, and of course we credit the bank cash or creditor, so nearly the same. Okay, the difference is for revenue expenditure we debit expense account, while for capital expenditure we debit the specific fixed asset accounts. Okay, so this appears in trading or profit and loss account, not in the balance sheet. Okay. Now, there is the last case, which is loan interest. Think of it in this way. You get a loan of 100,000. So you're supposed to pay back 120,000. So when paying back 120,000, is this 120,000 a capital expenditure or a revenue expenditure? The business is going to spend money, 120,000. Now, this money, is it a capital expenditure or revenue expenditure? So this 120,000 has got two parts. The first part is the 100,000, which was the loan that was used to run the business for a good amount of time. Okay. Then the 20,000, that is an additional money you are spending. Okay. So these two can be classified into capital and revenue. So loan repayment is capital expenditure. Okay, loan repayment is capital expenditure. The 100,000, the actual money you got, is capital expenditure. Okay, because it reduces liability. Okay, or it reduces the amount of money you owe other people. And of course, you can think of it in this way: when you got the loan, that was it was a long-term value that you were using to operate your business. Okay, so that constitutes capital expenditure. Okay, but the interest, that money on top, is revenue expenditure because it is the amount of money that you spend in an effort to get that loan to finance your business. Okay, so it is treated as a revenue expenditure. Loan interest is treated as a revenue expenditure, but the actual loan is capital expenditure. So if you have 100,000, 20,000 loan, the 20,000 is revenue expenditure. Well, the 100,000, the actual loan, is capital expenditure. Okay. So why are we learning about classifying which one is capital and revenue expenditure? One, misclassifying expenditure can, that's the first point now, overstate or understate profits. So if you have not classified your expenditure well, you may overstate or understate profits, meaning the profit that you're going to have may be too big than it is or too small than it is actually. Okay, so that's why it's very important to make sure that you classify the expenditure properly. Also, it can misrepresent asset values. Think of it in this way. You spent 100,000 to buy pens for resale. Then you record that as a purchase of fixed asset as a capital expenditure. So your books will be showing that the total asset value includes that 100,000 when that 100,000 is not part of the fixed assets. Okay, it is meant to be sold. Okay, so that's the importance of classifying of differentiating these two. Okay, also it can mislead investors and management. Okay, they'll think you have a lot of money or you don't have a lot of money, when actually you are in a different financial position. It can also affect the reliability of financial statements. Okay, therefore they cannot be reliable because of such misrepresentations. So this marks the end of the first part. See you in the next.